Well, a lot of hedge funds, I guess, are putting out their quarterly, making their quarterly filings. If you're a fund, you're supposed to publish every quarter what it is that you hold, what positions. I believe it's an SEC thing, because they're all securities or whatever. And they have ways of getting around this, kind of like what we saw with what was it called, Archegos, where they invent these derivative contracts that are not considered securities, but the contracts own securities, and these are ways that funds can conceal their positions so that they don't give away sort of the trade secrets. Because I guess if they're not an active, if they don't have like an active management style to where they're constantly buying and selling different assets, it is sort of giving away what the fund does if they publish all their positions. But that aside, Michael Burry, the guy from The Big Short, was making some news today, and it was because not so much what he owns, or I should say, not so much what he's long, what he's betting on, which is normally all that ever gets discussed in financial media. The idea of shorting anything these days is, it's laughable. It's not something that people take seriously, because you could throw a dart at a board, and whatever stock you hit, if you buy it, you're gonna make money, because everything goes up. As old what's his name, the guy from Barstool Sports, Portnoy, as Portnoy always says, they always go up. And thanks to the Fed, that's mostly true. But when the Fed loses control, that's when shorting will become cool again. And Michael Burry, I think I might have mentioned it back in February, had a pretty good Twitter thread about Weimar Germany and hyperinflation, talking about the U.S. And then he got a knock on the door from the SEC because they didn't like him talking about that. And so, he was censored, essentially, and said, you know what, I care more about making money than being able to speak freely. So if the since the SEC came and harassed me, that's enough of a warning for me to say, you know what, I'm not going to talk about financial markets publicly anymore. And so he quit tweeting. But now that his quarterly filing has been made, we see sort of the results of what he was talking about, what he was hinting at when he was talking about the problems of inflation that were coming to America and comparing it to Weimar Germany. Apparently, that was not just him being a fearmonger. He's putting his money where his mouth is, to the tune of like $250 million. Michael Burry manages over $1.5 billion. I think maybe $1.6 billion. And I guess I'll start with the juiciest bit of it, and that is his largest position, $530 million in puts for Tesla. Now, for those of you who don't know how options work, a put is an options contract to where if you own it, you have the option to sell the underlying asset, in this case Tesla stock, for a set price. And so what this is a kind of insurance to where if, let's say, price of Tesla is $100 a share, and you buy a put, excuse me, you buy a put for the option to sell your Tesla stock at $100 a share. If the price of Tesla stock plunges down to $10, the put is for $100 a share. If the price plunges down to $10, you can still get out of your Tesla stock for $100, and you didn't lose any money. Of course, the put itself carries a cost, so if you don't end up using the put, you lose that. But think of it like an insurance premium. Now, the reason why Michael Burry bought all of these puts is not because he owns a bunch of Tesla stock and he's trying to hedge his position, because he doesn't want the insurance to insure his own position. He bought it because everyone else who owns Tesla stock, which is everybody and their grandma right now, if the price of Tesla plummets down to a more reasonable level, and frankly, I think that he's correct in having his biggest position in shorting Tesla, because Tesla really is the biggest bubble in the world of any given asset. Of any single asset, Tesla is probably the biggest bubble by far. And so therefore, when the everything bubble pops and Tesla comes crashing down to earth with all the other assets in the world, Tesla is going to fall farther than anything else, farther than housing, farther than the overall stock market, farther than pretty much any other individual stock. And so, when that happens, all of these puts that Michael Burry has purchased, this $530 million in puts, will be worth a lot more than $530 million because everyone will be wanting to purchase those puts so that they can get out of their position. That's the logic behind this, just so that you, because if you just read the Zero Hedge article and you don't have a background in finance or any of the other articles on it, I'm sure Bloomberg and CNBC had articles about it too. If you don't understand the background on how that works, it might be a bit confusing. Like what's a put, what's a call? A call is the same, is kind of the flip side of a put. A call is something you buy to as a form of insurance in case the price of an asset goes up. A call is the option to buy something at a certain price. So therefore, like let's say you wanted to buy Tesla stock because you thought it was going to go up. Well, if you buy a call and then the price of Tesla goes up, you can, let's say, it goes from 100 to 200 and your call option is for 100. If you bought that call and then the price goes to 200, you can, exercise that call option. Buy Tesla stock at $100 and then, you can then resell that to somebody else for 200. And so we see in what was much more interesting to me than the Tesla stuff, a bunch of positions that essentially amount to about half the size of the Tesla position, maybe like I think I said earlier, $250 million. He has right now in shorting the U.S. Treasury market. And he does it. And that's in mostly options, a combination of puts on funds that are long Treasury bonds, and then also calls on options that are short, or on funds that are short Treasury bonds. And so what all that means is that Michael Burry is betting $250 million that interest rates are going to rise in the United States. And how is it that Mr. Burry thinks that's going to occur? Does he think that the Fed is going to raise interest rates? Perhaps, but based on how he was talking back in February before he got censored and muzzled by the Securities and Exchange Commission, it would seem as though Michael Burry shares my conclusion that the Fed is not going to rein in inflation. They're not going to raise interest rates. They are feeding into this inflation. They're causing it. It's by design. And the Fed knows that if they fought inflation, if they tried to raise interest rates, the whole bubble would come crashing down. And so if Michael Burry thinks that the Fed is going to allow some kind of Weimar-style hyperinflation, well, then interest rates are going to have to rise because the inflation premium is going to push up interest rates whether the Fed raises them or not. And so this means that Treasury bonds that are, being issued right now, that exist, that are in circulation right now, that yield like 1 or 2%, are going to be are going to lose a majority of their value if interest rates go up to like 10% or something. And again, if interest rates rise, the U.S. federal government's bankrupt. This is some serious stuff that Michael Burry is betting on. What Burry is doing right now, not just by shorting Tesla, although Tesla is a part of it, by shorting the Treasury market, he is really shorting the entire U.S. economy, the whole big bubble, the entire system. He's shorting the dollar itself and putting, again, a lot of money at stake. Now, maybe in percentage terms, it's not a huge share of his fund. It's more than 10%. It's maybe a little less than 1/6 of the entire fund that he's put into this. But again, that's a pretty serious bet. And the Tesla thing, I think the reason why he's not more heavily short the treasuries is because he's putting so much all in on Tesla. Because again, Tesla is an integral part of this bubble. The bubble is what made Tesla, and the bursting of the bubble is what will end Tesla. So I think that the reason why you see him shorting Tesla so much more than the bond market is that he thinks that Tesla has a lot more further to fall. But those dollars, that $500 million, if he wasn't shorting Tesla, it would not be long something else. If he did, if Tesla wasn't there, to make additional money on, I think the entirety of that $500 million would probably go to shorting the Treasury market or something else along those lines. Because I don't see a scenario where Tesla crashes and the Treasury market doesn't, or where the Treasury market crashes and Tesla doesn't. They're going to move in the same direction because they're both being driven by the same force, and that is, of course, the Fed's money printing. Oh, and did I mention that even who Michael Burry was? He was from the, if you've seen the Big Short movie, which is about, shorting the subprime housing market. I'm not familiar with Burry's track record. I know that he made a big bet on the housing market, and it ended up paying off for him. And timing these things is very, very difficult. So I don't think that he's some magic man necessarily. The timing on this stuff, if you're going to time this stuff right, you pretty much just got lucky, because logically, Michael Burry was correct back then, and he's correct now. But it's not pure logic that drives these markets. It's not logic at all. It's the central planners doing their best to distort logic and to oppress logic and make sure that it plays no role in these so-called markets. And so just because Michael Burry was right back then and he's right now, it doesn't mean that it's going to pay off for him right now. It might take quite a while. I don't know. I know that eventually what Michael Burry's positions are in, that will pay off eventually. But the question is, can he carry those positions? Can he stay? Because all these positions have carrying costs associated with them. Just like his when he had those credit default swaps on the mortgage-backed securities. That's it's a big topic in the movie. His clients were mad because he was just hemorrhaging capital every month or so, having to pay on those to carry them forward, because the housing market hadn't crashed yet, until it did, and then it paid off for him. The same thing is true here. We don't know the exact timing. It's quite possible that what this inflation that we're seeing picking up at the beginning of the year is only going to accelerate, and things are going to get really, really bad from here. But I don't know for sure. So as just a little guy here who doesn't even have enough money to go and try and risk on all this stuff, and frankly, I'm very risk averse. I would not be risking my money on this stuff, even though I know for a fact that I'm right. Because I don't know how, there's no way to gauge the timing. I don't know when the end will finally come. I just know I don't know how far we are along this road, but I know what path we're walking. And so it feels good to have somebody like Michael Burry in my corner, who essentially thinks the same way. And so this may end up being the Big Short 2.0. We'll know probably in a year. I made that claim before. I think we'll know which path we're going down, how this is going to play out in my 3 Roads to Economic Ruin video, which again I recommend you go back and watch. It's still relevant, everything I said in there. We should know by this fall. We should have a bit more clarity about which way things are going, especially since we'll have a few more months of inflation data by then, and we'll see if it continues or if it slows up a little bit. Because remember, the inflation can stop at any time, as soon as the federal government knocks it off with the stimmies and stops pumping money into consumption, printing money and essentially spending it on just buying up goods that without any production associated with it. As soon as the federal government and the Federal Reserve stop that, the inflation will end. But if they do that, if they willingly end the stimmy checks and all that, the economic pain which will result from it, the economic depression which will inevitably come, will be blamed on them. Whereas at least they feel like, well, if we just destroy the dollar, maybe people won't blame us as much because hey, we're still trying to send out checks, just like Venezuela. Venezuela, destroyed their currency by because they wanted to keep paying people and trying to make their standard of living good, give them lots of good welfare, and it ended up destroying their currency. And a lot of people blame the government for that in Venezuela, but a lot of folks don't. A lot of folks blame America for that, and maybe the authorities here in the U.S. think that they can pawn off the blame on somebody else, blame it on speculators, blame it on, I don't know, Russia. So we'll see, but dangerous times, that's for sure. So I think I'll leave it there.